Hello and good day. My name is Heavenly Taryn, and I am pleased that I am able to record this presentation for you today. Myself, along with 4 other students, have prepared this presentation especially for you. We will be presenting for our Group 2 oral project for our Financial Markets and Institutions class code FIN 4303, instructed by Dr. Julia Cho, which will be covering our research on the subprime mortgage crisis. We will be discussing with you the money center banks and the investment bankers. At the end of our presentation, you will know who some of the key players were, what role they played in the subprime mortgage crisis, if any risks were associated with them lending in the subprime, and where those key players are now. As I stated before, my name is Heavenly Taryn, and it is my pleasure to introduce to you our next presenters in their respective order. Shek, who is also known as Sam, will be pointing out the key players that we chose to do research on and present to you. Our next presenter, George, will be educating you on their individual roles that they played in the subprime mortgage crisis. And then Jonathan, who our next speaker is, will be explaining the risks, if any, that were associated with the key players lending in the subprime. And then last, but certainly not least, is Justin, and he will be giving you a small recap and then a farewell. Thank you very much. I hope you enjoy our educational project, and then we are now off to Sam.
Hello everyone, my name is Shek Fong. I'm going to talk about money central bank and investment bank. I'm going to give you a brief introduction of what are they, what do they do, and some major representatives in both of the banking system. So first, let me tell you what is money central bank. Money central bank used to refer to the central bank of the country. For example, in US, that's Federal Reserve. But now, we use the term money central bank to refer to commercial bank or some financial institution that give loans, because the commercial banks right today are providing most of the services that the money central bank does. There are 3 typical services that they will provide. First is the term deposit. Second is they making loans. And third is the merchant banking. Term deposits means that they accepting deposits from corporation, and they use part of these deposits to make loans to company or individual with high liquidity. And lastly, merchant banking means that they provide capital to company in the form of share ownership instead of loans. In the subprime mortgage crisis, Fannie Mae, Freddie Mac, JP Morgan Chase, and Merrill Lynch. These bank or institution are some representative in the category of money center bank. Next, I'm going to talk about investment bank. The 2 main services that provided by the investment bank are the underwrite security and they act as a broker. Underwrite security means that issuing the IPO, helping a company to go public. And act as a broker is they trade those securities in the secondary market. In the subprime mortgage crisis, the BSD, Lehman Brothers, Goldman Sachs are the main representative investment bank involved in the crisis. Next, my teammate George is going to talk about the role of those banks or institutions that I just mentioned above.
Hello, my name is George Safandrej, and I'm here to answer the second question, which had to deal with defining the role in the subprime financial crisis. On the most basic level, the legal and ethical implications of the financial crisis started with the deregulation of the industry during Clinton's presidency. Specifically, derivatives were deregulated, which were major causes to the financial crisis. As far as the money center banks, Fannie Mae and Freddie Mac were the major contributors in that field. They were both in spree of white collar crime, which also caused the actual crisis to occur. They had given out millions of loans that they knew that people couldn't pay back, and with those loans they sold the debt in what we like to call baskets of securities, with like risk ratings that had ratings from low all the way to high. And despite the majority of the loans that were issued, the majority of them were actually toxic loans. So banks from all over the world still bought them, and people bought them with insurance policies, which came from AIG, which is an insurance company, and they were sold in forms of credit default swaps. And people bought these credit default swaps knowing that they would get paid back in a small measure, that they knew the threat of the systematic risk would eventually trump the moral hazard, to the tune of like $700 billion, which they used in order to cover the troubled assets with relief money through what they called the TARP bill. And this also raised questions about the United States under the very small capital injection clause, why they would pay 100 cents on the dollar to bail out Fannie Mae and Freddie Mac while they knew that they were selling these loans with these ratings and these risks. As far as banks through the financial crisis, Bear Stearns was really the major cause which started everything. It was kind of like a domino effect. Bear Stearns was forced a buyout because they were basically filing bankruptcy, and with the help of Ben Bernanke and the Federal Reserve, they were able to actually come up with a deal to sell stock for $2 a share, and an additional $30 billion capital injection to cover the toxic assets that were in the field. And in this case, systematic risk trumpled moral hazard. However, as news reached many of the people's ears, Lehman Brothers was also starting now to have the same problem, because they were packed with full of toxic assets. And this led to moral hazard prevailing, to which, when Paulson said there will be no bailout for Lehman Brothers. So although Bear Stearns got basically the easy way out, Lehman Brothers, they completely rejected their bailout plan. So upon their collapse, it kind of ignited a chain reaction, because the toxic assets were backed up by insurance policies called credit default swaps. And these credit swaps were actually provided by AIG, and as more of the toxic assets were defaulting because homeowners couldn't pay their mortgages, AIG was flooded with pleas for the insurance money, which basically AIG was not able to afford to pay. And that basically sums up the whole start to the financial crisis, and those were the major contributors that had to deal with that actual crisis.
Okay, thank you, George. So where do the risks lie in the subprime mortgage crisis? Basically, it's in defaults. For example, Fannie Mae and Freddie Mae, they're both money centers. They're backed by the federal government, so they really didn't have any risk involved in their lending. On the other hand, Goldman Sachs actually made $4 billion in profits from subprime mortgage crisis by short selling the mortgage-backed securities. Two of the employees in the company saw the mortgage bubble bursting and convinced them to bet against the subprime mortgage crisis market, and it ended up working well for them. Lehman Brothers eventually filed for Chapter 11 bankruptcy, so they suffered great in their mortgage lending. JP Morgan Chase, they also were expecting the subprime mortgage crisis, and they exited most of their securitized subprime mortgage business before the meltdown. They were still exposed to some losses due to their shares in Fannie Mae and Freddie Mac, but they exited in time. to cut their losses. Stearns, obviously, we all know what happened with the Stearns. Their risk was associated with the risky mortgages that they purchased. They were not able to sell those hedge funds, and essentially they defaulted on their loans, and eventually J.P. Morgan Chase bought them out after a colossal downfall. Basically, that's where the risks lie in the subprime mortgage crisis. The banks exposed to all these risks because of defaulting borrowers.
Today, post-subprime mortgage crisis, the damaged money center banks are lending less, leading to lower levels of production and curtailed expansion of companies across the nation. Fannie Mae and Freddie Mac, two companies that have recently been accused of causing the burst of the housing bubble by guaranteeing highly risky mortgages, own about 250,000 of foreclosed homes and are seeing their yields tumble post-crisis. Fannie Mae's 30-year fixed mortgage securities, known as 30/60s, were hovering at 6 and 7% before the crisis and are now at 3%. Their stock price before the crisis was $65.33, now 23 cents. Freddie Mac's 30/60s were 8% before the crisis and are now 3.7. Their stock price was $60.97 before the crisis and is now at only 24 cents. J.P. Morgan Chase, who received $25 billion from Congress to not go under during the crisis, has emerged in far better shape than most of its competitors. With a yield of 3%, it has outperformed the likes of Citigroup and Merrill Lynch, but its quarterly dividends are still a full percent lower than it was before the crisis. Before the crisis, it was 0.380 and now 0.250. Today's stock price for J.P. Morgan Chase is $32.51, a far cry from a then $44.65.
Well, to recapitulate in a nutshell, we went through everything. As far as investments with bank go, they underwrite securities, and they also invest in other things versus like CDOs and collateralized mortgage debt. As far as defining their role in the subprime mortgage crisis, Bear Stearns and Fannie Mae and Freddie Mac, they all ensured that these home mortgages won't go down, and as far as that goes, it did. Unfortunately, these home mortgages did default, and these homeowners unfortunately could not pay back their mortgages, and unfortunately, all those CDOs, collateralized debt obligations, couldn't be paid off, either tranche, the first tranche, the second tranche, or the third tranche. Unfortunately, these banks were insured, and they took default, and they defaulted because of that. Where the risks lie, it all lies within homeowners being able to pay back, and unfortunately, because of the skyrocket interest rates being extremely low, it allowed these banks to lend out extremely amounts of money, and the way they made their money is through fees and through selling these mortgages and packaging them up in CDOs and selling them to these investment banks, these hedge funds, to investment banks just like J.P. Morgan, just like Bear Stearns, Goldman Sachs, and fortunately Goldman Sachs is the only one that actually made it out making money, versus J.P. Morgan that took a more defensive track by just exiting the game, but they did take a loss with their preferred stocks. As far as Fannie and Freddie Mae, even though they were kind of backed by the government, they did kind of fall. They did fall, and unfortunately, they messed up. As far as everything goes, the current status is now is that people are still underwater as far as their home mortgages go. People that were being able to afford their home mortgages and were paying them off, unfortunately, because of their neighbors that borrowed heavily and they couldn't pay it back, they're paying underwater, which means that the value of their house is far more than what they're actually paying it for. And as this is a lesson that could be learned in history, and hopefully this won't happen again. But we all understand that history does repeat itself. So thank you.